Today, bears are showing their teeth. Be clear, markets have further to fall. Hello again, it's Martin North from Digital Finance Analytics, from latest posts covering finance and property news with a distinctively Australian flavour. In this week's market review, we'll look at the US first, go across to Asia and Europe, and end up in Australia. And this past week was momentous, as central banks continue to lift rates in an attempt to crush inflation. A half dozen central banks, including the United States, Britain, Sweden, Switzerland and Norway, delivered rate hikes this week to fight inflation, but it was the Fed's signal that it expects high US rates to last all the way through 2023 that really caught the markets off guard. There have been some optimists out there saying that inflation may be coming under control, but the Fed effectively told them to sit down and shut up, said David Russell, VP of Market Intelligence at TradeStation Group. The Fed is trying to rip the band-aid off, trying to kill inflation while the job market is still strong. So finally, I think markets are waking up to what's happening. No immediate pivot, higher rates for longer, and even if house prices or markets fall, the Fed will continue. Goldman slashed its year-end target for the S&P 500 to 3,600 from 4,300, which it had made in mid-August. The expected path of interest rates is now higher than we'd previously assumed, which tilts the distribution of equity markets outcomes below our prior forecast, they said. Based on our client discussions, a majority of equity investors have adopted the view that a hard landing scenario is inevitable, and their focus is on the timing, magnitude and duration of a potential recession and investment strategies for that outlook, they said. And Federal Reserve Chair Jerome Powell said the US economy may be entering a new normal following disruptions from the COVID-19 pandemic. We continue to deal with an exceptional unusual set of disruptions, Powell told business and community leaders at a Fed Listens event in Washington. LPL Financial's Quincy Crosby said, what looks like the proverbial sell now and ask questions later downdraft in today's market is just that, raise cash as uncertainty and volatility climbs. Market levels from the Dow to the S&P 500 and over to the Nasdaq look as though they want to head lower to find that spot where all headwinds are discounted. With the Fed hiking rates into a slowing economy in which inflation is still well above trend, Morgan Stanley warned that weakness in economic activity will be more broadly spread. The bank cut its US growth forecast to 0% in 2022 from 0.2% previously, and its 2023 forecast to 0.5% from 1.3% previously. And last Monday, ANZ's latest economic forecast for the US economy said, based on current and expected price trends, we now forecast a terminal Fed funds rate of 4.75 to 5% to be reached by the second quarter of 2023, which is 100 basis points higher and almost 6 months later than we'd previously projected. Just about every economic outlook has the US and the world in general either close to or in recession next year. Now imagine what higher interest rates for longer will do for the risks of a recession. And they think the RBA will also be higher for longer. As evidence piles up that the stock market is caught in a bear market, the focus inevitably turns to analytics that will signal a high confidence forecast that the selling has reached exhaustion and a bottom has arrived. There are many possibilities for crunching the data and all come with caveats, but perhaps the leading first approximation is the start of interest rate cuts. As Bank of America's research group points out, Federal Reserve rate cuts tend to precede market bottoms. When the Fed starts cutting, the odds appear to shift in favour of correctly anticipating a market bottom, i.e. a calculated risk. But the bad news is that rate cuts are now nowhere on the near-term horizon. But a pivot, of course, is coming. It always does, eventually. And remember that equity valuations are based on expected future profits that are discounted by the prevailing forward view of interest rates. As rates rise, their value in present-day terms falls more. And in a recession, companies make less sales and margin and look to cut costs, so absolute earnings will also fall. And knowing what we now know, equities are still significantly overvalued in my view. Dire outlooks from a handful of companies have also added to woes in a seasonally weak period for markets. Having withdrawn its earnings forecast last week, FedEx outlined on Thursday cost cuts of up to $2.7 billion after falling demand hammered first quarter profits. The delivery jar stock slumped 3.4% to its lowest close since the 30th of June 2020. The cost-saving numbers, while impressive on a headline basis, is unlikely not nearly enough in the context of the high inflation and declining volumes, Deutsche Bank said in the note. The S&P 500's estimated earnings growth for the third quarter is at 4.6%, down from 5% last week. So where are we now? Well, all three indices suffered heavy weekly declines. The Nasdaq dropped 5.03%, its second straight week falling by more than 5%, with the S&P down 4.77% and the Dow 4% lower. In fact, the Dow, which fell into bear market territory intraday, narrowly avoided ending more than 20% lower than its January the 4th record all-time closing peak of 36,799.64 points, meaning the blue chip index did not actually attain a bear market label according to that widely used definition. But of course the S&P 500 and the Nasdaq are already in a bear market. The Dow Jones Industrial Average fell 1.62%, 29,590. The S&P 500 lost 1.72% to 3,693, and the Nasdaq Composite dropped 1.8% to 10,867. Consumer stocks, which are acutely vulnerable to slowing economic growth, fell more than 2% as investors priced in softer consumer spending. Travel and leisure stocks deepened their losses for the week, with cruise line and casino stocks coming under heavy pressure, but all 11 major S&P sectors declined, led by a 6.8% slide in energy shares, and within that, oil and gas-related stocks were pummeled by the decline in crude prices, which fell in response to concerns about demand in a recessionary environment and the strong US dollar. Oilfield services were particularly hit, with Hammerlick and Payne down 11.2% and Schlumberger dropping 8.4% and Halliburton down 8.7% to record its lowest finish since the 3rd of January. Rate-sensitive technology and growth stocks dropped, with Alphabet, Apple, Amazon, Microsoft and Tesla all falling between 1.3 and 4.6%. And shares of Costco Wholesale Corp dropped 4.3% after the big box retailer reported a fall in its fourth quarter profit margins. The Dow was also dragged lower by a more than 5% plunge in Boeing after the aerospace company said it reached a $200 million settlement on charges it misled investors about the 737 MAX crashes. The volatility index, the fear gauge, rose to a 3-month high of 29.92, and volumes on US exchanges were 13.29 billion shares compared with the 11.11 billion average over the last 20 sessions. Bond yields tracking the 10-year US Treasury note scaled a 12.5-year high after the latest session peaked above 3.8%. The yields reflect so-called real interest rates, or where the market thinks key lending rates set by the Federal Reserve would go. The 10-year Treasury closed at 3.687, while the 2-year was at 4.2032, still signalling a recession like mad. The US dollar index closed at 113.03, and that's its highest close against a basket of other currencies since May 2002. Remember, a strong dollar reduces demand for oil by making the fuel more expensive for buyers using other currencies, of course, including Australia. We had the dollar exploding higher and pushing down dollar-denominated commodities like oil, and growing fears over the looming global recession that is coming as the central banks raise interest rates, said John Kidloff, partner at Again Capital in New York. The former Treasury Chief Lawrence Summers also flagged dangers with a surging US dollar, which is adding to inflationary pressures for countries around the world and increasing pressure on overseas borrowers that have issued debt in the US currency. He also indicated that dollar appreciation, fueled by the Federal Reserve's shift to a more aggressive path of interest rate hikes, may continue. This is going to be an issue that's going to be with us for some time. Summers said countries are going to have to be adjusting to a very strong US dollar, and it will complicate macroeconomic management in many economies, he said. Now, one point worth noting is comparing Fed funds to the 2-year Treasury bond yield, a good short-term gauge of interest rates. The 2-year yield and Fed funds have been pretty correlated over the past 30 years. Typically, the 2-year yield leads Fed funds on the way up and down. But what happens when it reaches extremes? Because this is what we have today. Well, the 2-year yield is trading at an extremely overbought level. It's currently 76% above Fed funds. The next closest example over the past 3 decades was back in the 1990s, when it traded 26% above Fed funds before stalling out and heading lower. And Fed funds match yields currently over 4%, the odds are good that stocks and bonds will struggle. European stock markets weakened on Friday as investors digested a series of interest rate hikes in the region ahead of a fiscal update by the new UK administration. In Europe, the Stoxx 600 index joined US and regional peers in a bear market as fears of a looming recession hammered demand for risk assets. The index sank 2.34% by the close in London to the lowest level since December 2020. Total declines from a January record high are now 21%, confirming a technical bear market. Strategists at banks including Goldman Sachs and Bank of America have given up on a year-end rally for European stocks. Energy and miners led the sell-off among sectors today as commodities slumped on reduced demand concerns as global rate hikes weigh on economic growth. More defensive sectors like food and healthcare did perform better, while cyclicals slumped. The DAX in Germany closed 1.97% lower to 12,284, while the CAC 40 in France fell 2.28% to 5,783, and UK's FTSE fell 1.97% to 7,018.60. The Bank of England hiked its benchmark interest rate by 50 basis points on Thursday, its 7th consecutive rise, and the Swiss National Bank ended its period of negative rates, while the Norges Bank in Norway also hiked by 50 basis points and pointed to more hikes ahead. The European Central Bank also raised interest rates last week. The macroeconomic outlook in Europe is bleak, HSBC warned on Friday in a note, as supply chain disruptions and the impact of Russia's war in Ukraine on energy and food prices continue to stifle growth and force central banks to tighten monetary policy aggressively to rein in inflation. While there was some good economic news in Spain, as it upgraded its second quarter economic growth to 1.5%, up from a previous 1.1% announced 2 months ago, but France and German manufacturing PMI data remained in contraction territory, with the region's industrial base suffering from soaring energy costs. The market is currently trying to figure out how deep and how long the recession in Europe is going to be, said Joachim Clement, head of strategy, accounting and sustainability at Liberium Capital. This will take some more time, and in general we expect a bottom in this bear market not before the first quarter of 2023. The Eurozone's downturn in business activity deepened in September, a survey showed, suggesting a recession looms as consumers rein in spending and as governments urge energy conservation following Russia's moves to cut off European supply. And in corporate news, Credit Suisse stocks fell 7.8% on reports the Swiss lender is once again approaching investors for fresh cash as it attempts a radical overhaul of its investment bank. European stocks have come under particular pressure this year as they're more impacted by the war in Ukraine and the escalating energy crisis compared to US peers. Latest data showed private sector activity in the Eurozone contracted for a third month as record inflation eroded demand and forced more firms to limit production. Investors are also paying the most to ensure European high-grade corporate bonds against default since the height of the COVID pandemic, as monetary tightening and recession fears worsen business conditions. The euro-US dollar traded 0.6% lower at 0.9960. And we got a bunch of announcements from the UK as the new Prime Minister Liz Truss pivoted to Reaganomics, and they laid out tax cuts, unlimited banker bonuses and other measures designed to drive economic growth, all funded by up to £70 billion worth of additional borrowing by the government. The theory is lower taxes for the rich and they'll spend more. The good old Laffer curve. It's the most radical package of tax cuts for the UK since 1972, reducing levies both on worker pay and companies in an effort to boost the long-term potential of the economy. But economists are concerned the package is unaffordable and will trigger a currency crisis over concerns about rising debt. In fact, former Treasury Secretary Lawrence Summers, now a Harvard University professor, blasted the economic policies being adopted by the newly installed Prime Minister, saying they're creating the circumstances for the pound to sink past parity with the US dollar. It makes me very sorry to say, but I think the UK is behaving a bit like an emerging market, turning itself into a submerging market, Summers said. It would not surprise me if the pound eventually gets below the US dollar. This is simply not a moment for the kind of naive, wishful thinking, supply-side economics that is being pursued in Britain. Between Brexit, how far the Bank of England got behind the curve, and now these fiscal policies, I think Britain will be remembered for having pursued the worst macroeconomic policies of any major country in a long time. The pound on Friday slumped to its weakest since 1985, trading at 1.0858, down 3.54% on the day. The yield on the 5-year gilt was set for its biggest gain on record to 4.0840, and the 2-year was up significantly to 3.9445. Oil prices fell on Friday, on course for a fourth consecutive weekly decline after a series of interest rate hikes around the world increased fears of a global economic slowdown, hitting the demand for energy. The decision of Russia to escalate its invasion of Ukraine, mobilizing more troops to stem recent Ukraine gains. In fact, US crude futures traded 4.8% lower to $79.28 a barrel, while the Brent contract fell 4.21% to $86.65. Both now are back to price ranges before the Ukraine conflict kicked off. Oil prices plunged to an 8-month low, in fact, on Friday, as the US dollar hit its strongest level in more than 2 decades, and on fears that raising interest rates will tip major economies into recession, cutting demand for oil. It was the 4th straight week of declines for both benchmarks. That's the first time this has happened since December. Both in technically oversold territory, with WTI on track for its lowest settlement since January the 10th, and Brent for its lowest since January the 14th. Oil tanks as global growth concerns hit panic mode, given a chorus of central bank commitments to fight inflation. It seems central banks are poised to remain aggressive with rate hikes, and that will weaken both economic activity and the short-term crude demand outlook, said Ed Moyer. There's no escaping the wrath of the dollar, as gold traders are finding out. One of the yellow metal's most sacred support lines that held through its worst-selling storm in the past 2 years, $1,650 an ounce, broke on Friday as the dollar index continued with its onslaught of the 20-year highs we mentioned above. Gold's benchmark futures contract on New York's COMEX settled down 1.75% at 1,651. The session low was 1,648.60. The spot price of bullion, which is more closely followed than futures by some traders, was down $26.98 or 1.6% to 1,644.35. Spot gold's bottom for the day was 1,639.96. Asian stock markets fell further on Friday and were headed for deep weekly losses as rising interest rates across the globe threatened to destabilize economic growth and weighed on risk appetite. The Fed's latest move put Asian stock markets on course for a 4th straight week of losses, mirroring a similar trend on Wall Street. Technology stocks were the worst hit as rising interest rates saw investors discount future earnings from the sector. South Korea's Kospi index was among the worst performers of the day, down 1.81%, while Hong Kong's Hang Seng shed 1.18%. Hong Kong stocks were also the worst performers this week, losing 4.2%, as their high exposure to technology saw them bear the brunt of selling pressures. China's Shanghai Composite lost 0.66% amid continued concerns over a slowdown in China's economy and a weakening yuan against the dollar at 7.1284. The Nikkei 225 was down 0.58% to 27,153 as the Japanese central bank resorted to intervention to prop up the yen, which is headed for its biggest annual decline on record against the dollar. Lawrence Summers was scathing. This isn't the right approach. When you're intervening against the trend, when you're intervening against the direction of monetary policy, which is certainly the case in Japan, your intervention is likely to create opportunities for speculators as it is to be really effective in changing the path of currencies, he said. Australia's S&P ASX 200 index tumbled in catch-up trade after the holiday on Thursday. The S&P ASX 200 declined 1.87% on Friday, and the All Ords also lost 1.9%. Interest rate-sensitive technology stocks and early-stage companies with no pathways to profits posted the largest losses on Friday, while the ASX returned to trading after the Queen's Memorial public holiday. Afterpay's parent Block dropped 8.9% to 84.20. One Block security on the ASX is equivalent to one New York Stock Exchange traded Block security, which fell 5.9% to 55.93 US. Commodity prices managed to largely sustain their valuations as the implications of a global recession on demand were offset by the fresh escalation of Russian wars in Ukraine. Iron ore futures traded in Singapore down a little at 98.91 a tonne on the October contract. BHP Group rose 0.55% to 38.17. Rio Tinto firmed 1.94% to $93, and Mineral Resources dropped 3.3% to 67.63. On Friday, MinRes lost its lithium boss ahead of a planned spin-off of the lithium business. Woodside Energy fell 2% to 31.78, and coal miners Whitehaven Coal and New Hope Corp extended their record-breaking run. Whitehaven rose 2.7% to $9.20, and New Hope climbed 2.8% to $6.33. Lithium stocks reversed a series of speculative gains. Lake Resources fell 6.6% to 99 cents. Liontown Resources dropped 4.6% to $1.57, and Pilbara Minerals declined 1.8% to $4.85. Buy now, pay later Junior Sezzle fell 9% to 50.5 cents, and e-commerce fashion platform Satari dropped 8.6% to 80 cents. And cloud-based accounting software provider Xero declines 7.8% to 76.53. Among the banks, ANZ fell 0.93% to 23.38. CBA dropped 1.9% to 93.64. NAB fell 1.58% to 29.35. And Westpac slid 1.43% to 21.42. Macquarie dropped 3.1% to 165.57. In crypto land, Bitcoin is back around $19,000 on reaction buying from this week's oversold levels. In the lower region, the 18,400 to 800 range remains the support area for Bitcoin at the moment. A weekly close behind that area would lead potentially to a continuation of the downtrend in Bitcoin, with perhaps a target of $17,000 there. Ethereum, which continued its downward trend after the merge, found a footing at $1,250 after losing the former $1,320 level of support at the beginning of the week. And if Ethereum manages to stay around 1,320, the downward momentum can be expected to continue towards 1,100 with an increase in selling pressures. Although the pivotal week for global central banks is mostly behind us, investors need to consider several geopolitical risks that have yet to be fully priced into the crypto markets in the coming days. And it's true, I think, that both Bitcoin and Ethereum are now tracking the main US indices, meaning if markets fall, so will they. And so the downtrend is extending across all asset classes other than cash. Nothing is safe, and we can expect more falls ahead. Traders with short positions might do okay for now, but those with assets in superannuation, value is being ripped away, and property prices are also easing back. Metals remain tricky, with believers still holding to their views that they are protective, but alongside cryptos, we'll see. Sometimes sitting out of the market is the most sensible step as the downside momentum increases and as the bears come out to feed. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.